Your retirement plan scares the heck out of me. And in this video, I'm gonna walk through the 4 ways most people save for retirement, why that scares me, and give you a great investment option where you can put $0 down and have $12,000 a month income in retirement. Hey friends, I'm Paul Haley, Toronto realtor, investor, educator, and speaker, and I want to help you learn how to invest in real estate. So my cousins and my parents recently started talking to me about their retirement plan, and I realized that scares the heck out of me. And I thought, wow, this would be an interesting video. And I should, a little disclaimer, I am not a certified financial planner. I'm not qualified to tell you how to save for your retirement. I'm just going to tell you the different ways people do, how they scare me, and what is an opportunity for real estate investment that could really bolster your retirement plan. So the 4 main ways people plan for retirement, or none, they have no plan: a pension, saving for stocks, or selling their home. So let me walk through each of those and tell you a little bit about why they scare me. Okay, so first I want to give you a quick primer on inflation. What the heck is inflation? That's a great question. So inflation is the average price of a basket of goods in Canada increases a little bit each and every year. It's just a product of our debt-based fiat currency. So what that means is, in our target range is between 1 and 3%. So let's say it's 2%. What that means is a basket of goods that would have cost you $1 today will cost you $1.02 in a year from now. So what that means is the purchasing power of $1 in a year is actually more like 98 cents. So why this is important for retirement is, there's this, you want to keep up with inflation with your retirement savings, right? So you want to have enough so that after years and years, you're not strapped for cash based on retirement savings. And what it means is we have to, when we're looking at investments, we often have to look at inflation adjusted returns. So what that means is we adjust the percentage of returns to account for inflation, so we're comparing today's dollars to dollars in 25 years. So I'll kind of explain that as I go through the different areas. So there are 2 main problems with inflation. The first is substitution. So, let's say the price of steak goes crazy. Well, what they'll do in the basket of goods is they'll replace it with chicken or hot dogs, right? So, that's a bit of a problem if you like steak, because the price of steak could take off. And the second problem is it's talking about an average, right? So it's an average across Canada, and it's an average across even a city. So think about this. So the average housing increases across the city of Toronto, most people in the city of Toronto aren't really affected year to year over the of price increases, right? So, folks that live in rent control places, their rents are only going up the cost of inflation, and people that have a mortgage, their costs are really only changing when their mortgage is up. So it's only new people that move to the city, or people that are displaced, that are really bearing the brunt of any major cost increases. So that's the big problem. I read a study that from 2018 to 2019, the cost for someone moving to the city of Toronto increased by $500 a month. Okay, so the first plan is no plan. That's not a great plan, but for some people that's the reality. And luckily in Canada there are 2 things that can help you if you have no plan. The first is called old age security. Everybody gets that, and it can start at age 65. Right now it's about $1,165 a month that you automatically get. The only thing is there is a clawback if you make a certain amount of money, and that changes every year. And old age security is also indexed to inflation. So like I was talking about inflation, so what that means is it grows a little bit every year to keep up with inflation, which is good. And the second one is called the Canadian Pension Plan. So you actually have to pay into this, and the maximum right now is $1,176. That also changes every year. It's indexed to inflation. So what's the problem with those 2 measurements? Nothing really. I mean, it's great, and part of another retirement strategy, it's okay. But if you're just relying on that, $2,000 plus a month, that's not a lot of money. It's not a lot of money to live in a big city, and it's not a lot of money to move to a big city where, prices are increasing quickly. So even though it's indexed to inflation, you can see how you would quickly get priced out of really having a great, comfortable retirement just on CPP and old age security. Okay, so the second retirement plan is what's called a pension, and there's two kind of pensions. There's defined benefit and defined contribution. So defined benefit is at a certain age, you get a certain guaranteed type of payments. Now there's two types of defined benefit. There's indexed to inflation and non-indexed. So index is obviously better because that number will go up each and every year as inflation goes up, and non-indexed won't. Which, like we've mentioned with the other, with the no plan, with your CPP and your OAS, is, things can quickly become unaffordable. And that's why this one scares the heck out of me. And a defined contribution pension is really like we'll talk about in a minute, but it's where they're putting some contribution every month and investing it in a certain stocks, and normally you get to pick from different portfolios what that is. So it's not bad. It's also not a guaranteed pension number when you retire. So I was talking to my cousin recently. He has a great plan for retirement. He's going to save a bunch of money, invest it in the stock market, and he wants to retire early so he can spend lots of time with his kids. That's a great plan, but it scares the heck out of me, and here's why. Okay, so first of all, you need to know, in Canada, if you want a comfortable retirement, you need to save $1 million cash money in the stock market. And so what that means is, at a 6.4% return, inflation-adjusted return, you need to save $16,500 per year for the next 25 years. And if your returns are only 5% inflation adjusted, then you need to save $20,000 a year, which is a little bit more realistic for 25 years. So stock markets are expected to go 5 to 7.5% on average over the next 25 years, and inflation adjusted, so that's a little over 5%. So shoot for the 20 grand. Okay, so why do stocks scare me? Well, stocks are very volatile, and the first thing you need to know about the stock market is it's not a place where stocks sit, right? It's just an exchange, so it's just you and someone else buying and selling a stock, right? It's like eBay. A lot of people think it's like the stocks live there, and you buy it from the stock market and then sell it back to the stock market. No, you buy it from someone else and sell it to someone else, right? That's the only way that stocks get sold. I mean, sometimes companies buy them back, but that's complicated. So the second thing to think about is, what is a stock and why does it have value? On one end of the spectrum, people think, basically like you're buying, these great companies that make stuff and sell them to people and make money, and you're investing in that, right? On the other end of the spectrum, it's really, you're buying a piece of paper that they have no legal obligation to pay you any of the money that a company makes. Some of them don't even make money, and a lot of them don't even pay dividends. And you can't sell that stock back to the company. Yeah, sometimes they buy them back, but you're only really selling it to someone else. And honestly, I'm caught in the middle. I kind of think both. So what that means is the stock market can be very, very volatile, because it's often driven by, A, sentiment around a particular stock, and B, just, people's willingness to buy in and out of the stock market. So, as people get excited about the stock market, they'll jump in, and that'll inflate prices. And if they're scared, then they'll, run away, and that will deflate prices. It has less to do with the actual stock itself and more to do with, people's appetite for investment, if that makes sense. And let me highlight this, when the market crashed in 2008, I had my friend's father was very excited about retiring, and he was going to retire right when the stock market crashed. His portfolio got cut in half, and he got scared because the stock market really trades on greed and fear, and he sold, and it really messed up his retirements. I don't mean to lie. It was devastating for him, right? And that's why it scares the heck out of me, because if you don't plan it right, or if that's the thing that you're counting on to fund your retirement, it could all go to crap just before you're ready to retire, right? So it scares me, and that's why. Okay, selling your house. This is, well, my parents have a pension, but recently they're talking about, we're gonna sell our house, we're gonna rent, life's gonna be so much easier, they're gonna be happier. This one scares the heck out of me, and let me explain why. And let me tell you a little story. So I was actually showing some downsizers, so they were looking at selling their house, buying another condo, and we went to a condo. I met this lovely couple. They were the tenants there, and they had sold their house 5 years ago, moved into this great condo, had great rent, and they were excited to spend their retirement years in this condo. Then the owner decided to sell, and they were getting kicked out, and they were very stressed because now, their pensions, they couldn't afford rent in the city, and they certainly couldn't afford to buy the type of condo where they were living because prices just had gone so high. So that's why it scares the heck out of me. So listen, if you're renting in a building in Ontario with 5 units or more, landlords can't kick you out, and they can't raise the rent more than 5. Well, there's certain situations they can kick you out, but it's much less likely. And they can only raise the rent 2%, except on brand new buildings. They can raise it whatever they want. So, that's a little bit scary. So if you're not in one of those buildings, if you're not going to move to one of those buildings where they can't increase the rent to market rents, then you're, maybe more relatively safe. But, the problem is oftentimes those buildings aren't where people want to live and spend your golden years in retirement, right? So that's why it scares me, because, my parents are like, oh, it'll be great. We'll live in this place. We won't have all the stress. But if you have to move every 3, 4, 5 years, that's going to be really stressful. I hate moving. They lived in their house for a very long time. They don't like moving. So that scares me. Okay, so what the heck should I do about it, Paul Haley? That's a great question. And so, I was really excited to think about this because I have a friend. My real estate goal is to just grow. But his real estate goal, he also lives in my neighborhood. We both live for free. So we bond on that. His goal, and what he's done is he's bought properties in a B city, a Canadian B city, and he's paying down the mortgage over the years. And that's going to be his retirement. He's going to have, 5 places that are mortgage-free, just churning out rent, and that's what's going to cover his retirement. I actually think that's a pretty good plan, and especially if you use investing with some of the other ones, it can be a great supplement to your retirement. So I crunched the numbers, and let me tell you what I found. So here, let me explain to you the assumptions. So what I assumed is you're going to pull out $250,000 from your current home equity to buy an investment property. Now, if you're thinking, well, I don't have $250,000, well, that's going to add a little bit of time because you're going to have to build that or go buy a place to build enough equity to go and do this, okay? So then I assumed that you bought $1 million property with that $250,000. You rented it for $6,000 a month, the whole thing. Your net operating income is $53,000 a month. If you want to learn more about what that means and how to calculate that, check out this video or below. Now, I also assumed that the property's value grew at 3% a year, inflation adjusted. The actual number in Canada is 5.5%, and in Toronto it's been more like 7, 8, 9, 10% over the past 10 years, but I'm being a little bit conservative. I also assumed the rent grew 2% above and beyond inflation. It's been a lot higher than that in the city of Toronto. 7 to double digits each and every year. But again, I wanted to be conservative. I wanted to, see how the numbers would play out for this thing. So the other assumption is you're taking the earnings from your property and first of all, you're paying interest on that $250,000, but you're paying it down over the years. And then when that's paid off, then you're paying down your mortgage for the 25 years. So at the end of the 25 years, you're going to be mortgage free. And I assumed after 5 years, you're going to take the equity from the initial property and buy another one so you get to that $12,000 a month, right? So what were the results? The results were at the end of 25 years, you would be making $12,000 a month in today's dollars, so that's inflation adjusted. It's probably going to be a lot higher because market rents will go up a lot. And those properties are worth $3.8 million. And you did all that with no money down, no extra money down. You took it from your home equity and you paid it back off, right? I don't know about you, but that's pretty amazing, right? a free $12,000 a year. I mean, it's going to take you some work, but you know, really, that I personally think that's amazing. Now, to compare that to my plan is to grow, you know, a bunch of real estate over the years, and I'll show you a link to that video. But the end of 25 years in that plan, I would have 32 properties, cash flowing $32,000 plus inflation a month, right? And I would have $17.5 million in equity that in 5 years after that would turn into $36.5 million. I still think that's a great plan, but either way, it's great. So there's lots of ways to save for your retirement. I'm not a CFP, but you know, I think if you have a balanced approach, if you have a bunch of different ways, you know, maybe pensions, you're definitely going to get OAS, maybe CPP. You're going to save some money in the stock market. Don't recommend selling your house, but you could. And you have some real estate investment. You know, I feel much safer about that approach to retirement than any one of all the other things, right? I hope you found that hugely helpful. Please leave a comment. Please like this video so I'll know to make more. Please smash that subscribe button so you get updated every time I post a new video. And if you want to chat real estate, or you want to talk about, you know, what a real estate investment can do for you, please shoot me an email, paul@paulhaley.ca, or book a free investor consultation below. Talk soon. All right. What do I want to say? Okay, so first I want to give you, I already did that part. Well, I'll do it again. That could really bolster your retirement plan. Mosquito is worth $1. Well, it's actually, let me start again. He's gonna save, you know, a bunch of money so he could retire early and spend time with his kids. Chipmunk. They really distract me. They're so cute. Don't run on me. See you. Play. Now they're going tubing. Please just let me get through it. Hell, you noisemakers. Just go to lunch or something.